Well, hello everyone and welcome into crushthestreet.com. My name is Kenneth Amaduri, and today we got a special show. A lot of people are concerned about September, and it's September 11th, and we have a special briefing, and we wanted to bring in a guest that you are familiar with. His name is Nicholas Green. He's of fmtadvisory.com, and he warned us about a few weeks ago now, I think it was, or maybe it was about a month now, about the Dow to gold ratio, and it being high. And we, sure enough, have seen this ratio come down, just as he had predicted. And he's back. I want to get his thoughts on the economy. Nicholas, thanks for joining me today.
Thank you so much for having me on your show, Kenny. It's great to be here again.
Absolutely. Well, I'm excited to have you on, and you know, it's important that we talk about these issues because there's a lot of volatility in our markets now, and I wanted to get an expert opinion on where the markets are headed because a lot of people, they're searching for what to do, and that's why I wanted to have you on and to be able to address these topics.
Yeah, sure, that's great. And you know, it's actually why I put out a piece titled Putting 100 Years on Your Side. And, you know, I've been offering it free. It's just a simple piece about really putting 100 years of data on your side and on your financial side to help protect and, you know, to help ultimately protect and thrive from. So yeah, these are important times for sure. And so I'm happy to be here to discuss them.
So, Nicholas, as of right now, based on what we've seen over the last month, where do you see the markets headed?
Well, it's funny because you mentioned how on our Dow to gold ratio interview that we did a few weeks ago, I basically said we're right there right now, and it's time to pay attention to it. And the reason why was just based on valuation metrics and you know, the 100 years of history that I'm talking about. And so anytime we've gotten into this zone, basically real assets have gotten cheap and financial assets have gotten expensive. And so I was basically reiterating to lower financial asset risk by lowering your stock exposure, not going down to zero, but going down to the bottom end, shoring up cash and reallocating towards real assets. And that's been great. You know, one way to put 100 years of history on your side would have been just going short the market and long gold, and you'd actually be up well over 10% in this huge market sort of correction that we're watching unfold. But of course, if someone has $1 million, you're not going to go $500,000 short the market and $500,000 long gold. So the default is, you know, cash is actually essentially shorting the market because you're not in the market and you're getting better values for your money as they come down, and it's good firepower. So that's the more prudent way to do it when you're sitting on serious wealth. But you know, but the interesting thing is, yeah, putting a short on the Dow or a major index and long gold would have protected you through these historical ratios that we're at, and we're still at historical ratios. And if it just corrects to the medium long-term average of 9.7, but you know, the market can correct against something like, you know, gold another about 30% just to get back to the average ratios. But what's going on in the markets is just really interesting from a sort of a currency standpoint, and that's something I would like to talk about, is what's going on with China, Russia, Malaysia, Saudi Arabia, and the Fed raising interest rates, because it really is a currency contraction, which is deflationary in nature, and that's what we're looking at as the economy is hitting the soft patch, as the rail shipments on the railroads are slowing down, and as the five-year break-even forwards are actually trending lower, which is the inflation expectations of the market, they're actually starting to trend negative, and they're going down, and yet the Fed is acting as though they're going to raise interest rates into this. And so this is definitely a time to hit the foxhole and get prepared and be planned, because to be victorious in this war, you need to plan ahead. You're not going to do it by reacting to events as they come.
No, that's true, and it's very smart. And I mean, you've been spot on in your calls. So I wanted to ask you a little more about what's going on with China and the rest of the world and currency. And we were talking before the interview, and it was really interesting because no one else that I've heard, I'm sure someone might be talking about it, but no one that I've listened to is talking about reverse QE. And I'd like you to explain that to our audience and just to explain what is fundamentally happening to the U.S. and potentially what will essentially overwhelm the system.
Yeah, absolutely. It's fascinating what's going on and what has been going on. What you've seen is in foreign exchange markets and currencies around the world, they've just gotten extremely volatile. You look at the yen, you look at the Russian ruble, now you've got the yuan. And so this is what's been happening as, you know, the dollar's been strengthening, you've got all these other currencies wobbling. What is going on is with China specifically is earlier in the year they dumped about $100 billion worth of U.S. Treasuries, and then in the last month they've dumped another $100 billion. What China's essentially trying to do is they're trying to shore up the yuan or the renminbi from crashing, because what's happening is as we are threatening to raise interest rates and as the dollar is strengthening, all these other currencies just want to get excruciatingly weak against the dollar. Well, China is actually, one of the largest holders, obviously, of our foreign exchange reserves. And what they've been doing to protect the yuan and the renminbi from completely crashing, like, say, the ruble or the yen, what they've been doing is selling U.S. Treasuries. But when you have a huge entity like China selling $100 billion in U.S. Treasuries in a single month, which they did over the last month, that's akin to about almost a month and a half of when we're quantitative easing or putting money into our system. You have China pulling money out of our system. And so this is a very destabilizing effect, and it's a very contraction in our currency supply, which is deflationary. And that's why you've seen the market and the Dow lose almost over 2,000 points in the last month. And you're seeing this crazy volatility because you're seeing a contraction in our currency while the U.S. Federal Reserve is potentially going to raise interest rates next week, which will make it even worse. And so here's an interesting point. The Chinese foreign minister, Wang Yi is basically reaching out and asking the U.S. for global stability. What he's really asking for is that he's asking the U.S. to not raise interest rates. Because if we raise interest rates more, it'll put more pressure on the foreign currencies around the world, whether it's the Russian ruble, the yen, the Chinese yuan. And it will force those companies or those countries to actually pull more foreign reserves out of the U.S. market. And if they pull more foreign reserves out of the U.S. market, you'll see markets around the world get more volatile and be more destabilized. Not just our U.S. markets, but markets everywhere around the world. And so this is what happens when you have central banks coordinating for years on end, trying to keep their currencies within some kind of fair world zone for purchasing power parity. Eventually, they're putting band-aids on the dam, and eventually it starts to crack. And that's what you're seeing. You're seeing the cracks of their collusion sort of breaking down. And if we start, I'm sorry, go ahead.
Well, I was just going to interrupt you for a minute. So what you're talking about is QE in reverse, in case anyone missed that. So we have the government purchasing its own treasury bonds and mortgage-backed securities, doing these QE-type programs, and then on foreign countries selling dumping these treasuries back onto the market. So there's this counter effect going on. Now, Nick, I understand that QE is inflationary, so the reverse of QE theoretically should be deflationary, and that's what you're saying. However, intuitively, I would also think that when you dump treasuries, there's a lower demand for dollars. The dollar strengthens when there's a demand for it, and if countries are dumping it, isn't that also inflationary?
Well, if countries are dumping our U.S. Treasuries, it's putting more pressure on our markets, because all of a sudden you have more supply coming into our markets. And so if we raise interest rates and now these foreign currencies, or these foreign countries, these countries, like say, also the low oil prices is destabilizing the finances of, say, Saudi Arabia. So that's also forcing Saudi Arabia to sell U.S. Treasuries. So you have all these. So your question kind of like, well, if we're selling all these countries are selling these treasuries, isn't this cash coming back to haunt us as an inflationary effect? And eventually it could. But right now, what we're dealing with is a deflationary scenario. So there's been no huge problem getting a bid for the United States Treasury bonds as the stock markets have unraveled, because the stock markets have unraveled based on the contraction of basically QE in reverse, or the money being deposited in their system instead money is being taken out of our system, and so you see a contraction in our markets because of that. But what will happen is if they keep doing it, yes, there could be a point where we lose control. It could become a bigger crisis in 2008, 2009 if we lose control of our interest rates, because if we lose our biggest buyers, which has been foreign reserves count for 53% of our debt outstanding right now, and right now that's what's really been sort of perpetuating our debt-based economy, is all these foreign buyers. Well, if we lose the foreign buyers of our debt and interest rates get away from us, the Fed will have no choice but to come in and do a QE4, and that's going to be highly disruptive to the dollar. It'll be a dollar negative, and that will in turn essentially be what you're saying, which will be ultimately inflationary should this keep happening, no doubt about it.
So on that note, Nick, how low do you expect the markets to go? I know that's a tough question.
Well, it's a tough question. Sun Tzu once said to win a war, you need to be prepared, and you're victorious before you enter the war, and basically meaning you're planning before the war, you go into the war, and that's what I've been warning and helping people with, is making sure they have dry powder and cash based on the historical valuations. And so I don't have a prediction on what the markets will essentially do. What you have to do is be nimble and smart enough to pay attention to what moves the markets, and what moves the markets and what has moved the markets is easy money and stimulus. And so we have the reverse of that right now, and that can change. We can all of a sudden get more stimulus, and the Fed might not raise interest rates and then start threatening QE. But the way to win this war is just to be prepared in advance. And so you want to have real assets derive great income, promissory notes, those types of things. You want to have plenty of dry powder to add into markets as they become potentially much cheaper. You want to have also some real assets, as in, I think that some gold miners are historically some of the cheapest valuations they've been in 100 years. So I think that's a good part of a portfolio. And I think keeping some of your money in, if you can't find some value in markets, you're not doing your job. So you shouldn't be 100% cash or 100% promissory notes or 100% real estate. You should always keep a percentage of your money in deep value, good companies that are cheap. And there's cheap companies out there, but just you want to keep some dry powder ready to roll for when the opportunities come. And so far that's been working out, right? The cash is looking good right now.
So Nicholas, there's two parts to the Dow to gold ratio. And with what you said that the Dow to gold ratio is going to go lower. And for that to happen, two things can happen. That's the stock prices can go down, which would cause the Dow to gold ratio to get smaller, or gold to go up. And up until now, we've only seen one aspect to that equation happen, which is stocks get lower. But gold hasn't exactly gone up very much. So I wanted to get your thoughts on gold at this point, and is gold a safe haven at these prices?
Well, it's funny. Let me just backtrack to what I said earlier in the conversation. If you were short the market and long gold during this entire correction, you would have an over 10% return. Most people would be pretty happy with an over 10% rate of return. Here's the problem with that, like I just said, though. for serious money, can you really have a portfolio that's short the market and long gold? For a percentage of your portfolio, you certainly could do that. But for serious real money, because that can move against you for a prolonged period of time before it works in your favor. So most people don't have the tolerance for that, even though historically that has worked out 100% of the time for these ratios. So the point is I don't really know where gold in the markets are going to go, and anyone who says they are lying or ignorant. But for example, if you believe in the Harry Dent thing, right? If everything is going to crash, essentially, even Harry Dent says he's putting an intermediate price on gold of 700-800, but he's putting a price on the Dow at 6,000. You'll clean up if you're short the Dow and long gold, because gold will go down a heck of a lot less than the Dow, even in the Harry Dent scenario. So historically, that's a great trade. Again, the problem is can you really execute that? And the answer is no, not with all your long-term serious money, but you can do it with a portion of it. Another portion, you can have cash sitting as dry powder in a future opportunity fund as this plays out. And then you can have some good companies. I mean, I've been doing interviews, and I've been talking about one of my favorite food companies, and it's roughly flat while the Dow's still down over 2,000 points. I'm waiting for a better pullback so I can add to people's accounts, and it just won't go down. And it's because it's a great company run by some of the best people in the world. So there's things that own in a portfolio still on the long side, but you want to have a balance of having plenty of cash for dry powder. You want to have great companies in your portfolio. You want to have some real assets, and if you are really an entrepreneurial risk taker, go short a major index and go long gold. You'll be happy in 3 or 4 or 5 years. You would be happy in the last month as well. But this is a trade that has historically worked out every single time from these metrics. So whether we go into a 1929 depression, if that's what you think, long gold, short the Dow, or short the NASDAQ is almost a foolproof bet. If you think we're going into 1970s inflationary style period, then short the Dow and long gold's going to work out. If you think we're at a 2,000 year ratio where tech stocks were in a bubble and the market was in a bubble, and you were short that and long gold, you would have made out like a bandit. So anytime you've got these historical ratios with the Dow to gold ratio, and you were actually short the major index and long gold, you would have actually ended up making money while everyone else was getting paupered. Again, though, this is a very aggressive idea, and I wouldn't recommend it for most people, because I don't think most people have the wherewithal, the tolerance, or the intestinal fortitude to put on a trade like this. But as a part of our portfolio, it's certainly interesting.
Nicholas, in conclusion, what is your action plan for the clients? I know you've kind of alluded to it, but just kind of in a wrapping up sort of way, what are you suggesting at the moment, and what is your action plan for people?
That's great. That's a great question. So I've been unyielding and unremitting in this advice. I've told people to lower their stock exposure to a much lower weighting, but to still own great companies. I've recommending reallocating and rebalancing into more real assets, such as our real asset income idea that you can only get through us at the yield that we offer it at. That is non-correlated to the market completely and pays a monthly stream of income. I've recommended having cash as dry powder. I've recommended specific securities. There's a gold miner that I'm investing in today, and I believe that owning some gold in the portfolio is a great idea too. But I don't believe it's about being too cute here. I think it's about being pragmatic and being ready to go in with precision as this moves forward. But again, you're victorious before you go into war. We're in war now, so being victorious is we're already there. We've been prepared for this, and now it's just about creating a shopping list, creating a basket of things we want to own and buy as things get cheaper, and pounce on it when it happens.
Well, there you have it, everyone. That's Nicholas Green with FMTadvisory.com. If you want to reach out to him, definitely check out the site. and he can give you more information on actionable investment ideas and ways to combat this ever-changing economy. Nicholas, thanks so much for joining me today and coming on the show.
Thanks a lot for having me. It's been fun.